Good afternoon, everybody. Hope you had a nice lunch. As people file in, we're going to start talking private markets and climate and the transition and resilience. My name's Toby Mitchenall. I edit a publication called New Private Markets, and we cover anything within the realm of sustainability within private markets. So everything from impact investing all the way through to ESG, best and worst practice amongst private equity investors. I liked the way Alistair from Bloomberg got everyone to introduce themselves this morning, which was just to give a very brief intro from our panelists to say who they are and how private markets and climate kind of intersects with their roles and how that relates to what they do. So, without further ado, perhaps, Desiree, we could start with you, Desiree?
Sure. Most people here know me as the whistleblower, but if Billy's in the room, he knows that I date back to alternatives, derivatives, OTC, structured products, back to the mid-90s. So right now I'm an advisor to the FCA, the Monetary Authority of Singapore. I do, other ESG advisory projects, but I'm here because in 2005 I transitioned into impact investing and started impact private debt and did a whole series of impact securitization. So that's my relevance here.
Hello, Alex. I'm Alex Money. I feel like I'm doing whatever job is left to be done, really. I'll probably be cleaning the windows by the end of today. But in this particular role, I run a program on infrastructure for sustainable development here at the Oxford Smith School, and my own expertise, I suppose, is in blended finance for infrastructure investments in the global south. So that's my shtick.
Excellent. Ben?
Hello, good afternoon. I'm Ben Meng. I'm the Executive Vice President and Chairman of Asia Pacific for Franklin Templeton. Those two are titles, not my real job. So my two real jobs, I run our global private equity, and also in that capacity, I also work closely with Ann Simpson as our firm's executive sponsor of sustainability. So these are my two jobs, private equity and sustainability. So impact investing or sustainable investing in private market is squarely what I do. Thank you.
Good afternoon. My name is Pete Dunbar. I'm the head of private equity for the PRI, the Principles for Responsible Investment. Never quite sure whether I need to explain what the PRI is, but it's a global advocate of responsible investment. I think we have somewhere north of 5,000 signatories now, and around about, I think at the last count, $120 trillion of AUM of those signatories. I look after the private equity, which includes VC, buyout, growth equity investors among those signatories, which has grown an awful lot actually over the last 3 years. I think we've got around 1,200 to 1,300 private equity and venture capital signatories now out of that total 5,000, which is there are asset owners among that as well, but it's around about a third, I think, of the investment manager universe of PRI signatories. So, quite an increasing constituent of signatories for the PRI. Going back to what Ben said about the kind of title versus the actual job, I guess my the group I work with has been the investment practices team. So we're working with private equity firms, venture capital firms, the asset owners, the LPs that invest in them to try to kind of co-create tools, guidance for the industry to help them integrate the 5 principles of the PRI. So trying to help standardization, for example, our due diligence questionnaires for private equity, and just generally support the ecosystem. It's a bit of a sort of, what's the term, the kind of flying, building the plane while you're trying to fly it in terms of private equity, in the sense that a lot of the pre-existing frameworks for net zero and things don't really quite work for private equity. So there's been a lot of work over the last few years to try to adapt them for the asset class.
Excellent. Thank you very much. So a good mix of panelists. I was hoping to just set the scene a little bit, because in a conference about sustainable finance, so much of the discussion revolves around engagement with public companies, which obviously they are still the biggest companies in the world, but private markets has become a much more significant part of institutional portfolios and, maybe more importantly, a bigger backer of the real economy. So, well, as I said, the largest companies in the world are public companies, often the more sort of foundational ones, if you like, or the more boring, less sexy ones end up in private hands. And I was going to give just a couple of data points to sort of illustrate the way that's gone. Get these slides up, do I just... Oh, marvellous. So, skipping on to the next one. Not this one. Am I in control of this? I am. No? Can we have the next? Here we go. Okay. So this is not one of my charts. This is from a company called Partners Group. But it literally shows that since 2016, the amount of equity issuance on public markets was overtaken by the amount of private capital funds raised. So that maybe they're not too directly
Can I ask, is that private equity or both private debt and equity?
Well, actually, private markets would, don't quote me on it, but here we go, private equity, real estate, and infrastructure.
Okay.
So, sort of direction of travel is there's a lot more money raised and waiting for deployment by private management, private equity, private fund managers. But yeah, I mean, the other data point is that, not one that I have to point to hand, but it is something like, since the late 90s, a number of listed companies, and I guess we're talking about corporates here, listed companies in the US has halved from something like 8,000 to 4,000 odd. So a lot more of the action is happening in private markets. And then in terms of our discussion today, we're going to be asking, so what role will private markets play in transition, combating the climate crisis? And there's three areas we're going to talk about. Being, implementing change within their own portfolios. Number two, raising capital to invest in climate solutions and scale climate solutions. And three, acting as a vessel to allow government money or DFI money to flow to where it needs to be. So if we could go for the first of those. As owners of large swathes of the real economy, should private markets firms be well suited to drive the decarbonisation of the real economy? And maybe we could start with you on that, Ben.
Oh, sure. Thanks, Toby. This is a very important question, actually. We've been thinking long and hard, and that's why we decided to spend a lot of effort in private market first. There's a couple of reasons that Toby just showed us that private market continues to play a bigger and bigger role relative to public markets. In addition to what Toby showed us in terms of the capital raised, we also know that more and more companies are staying private for longer. So for us to make the difference, we have to go into the private market because more and more companies are staying private for longer. That's very consistent with all the private capital because they don't have to go to public market to raise capital. There's a flood of capital in the private market. So that's one reason. And then the other reason we talk about climate solution, most of them are technological solutions. And technological solutions are better fitted for venture capital and private equity to invest in first. Public market is more interested in the mature business model, mature technology. So with some technology risk, a private market is better positioned to take on the technology risk. So that's the second reason. The third reason is that in order to make an impact and decarbonize the economy, work with the company, you need to be in a control position. So private equity, the ownership is concentrated, and you get part of the investment thesis of private equity is to get involved with the management of the portfolio company. So because of the control, the ownership you have, it's much easier for you to effect changes. And lastly, but not least, private market also give you a longer investment horizon. So many of the, again, climate solution technologies, the technological solution needs a little bit longer runway to manifest itself, to benefit the financial benefit, the social benefit, the environmental benefit, just takes some time. In public market, as we know, they call the voting machine, a daily voting machine. It's harder for public company to stay a long-term focus. They have to answer their quarterly earnings, investor calls, a lot of distraction from the long-term investment horizon. So these are the number of reasons why we believe private market is in the front row seat, in the driver's seat, in terms of decarbonizing the society and the economy.
So that's the argument for. Does anyone else want to weigh in on the sort of suitability of it as an ownership model, as an investment model?
I might just introduce, just add to that and just talk about venture capital, how important, to solve all problems. Yesterday I was on a panel largely about the stick, and this panel is very much about the carrot. And, we need further innovation. And so it's private equity and venture capital.
Pete, do you want to come in on that?
Yeah, I guess just a kind of couple of things to reinforce what Ben was saying, really. Definitely the kind of whole private equity model itself and the governance structures around private equity, would seem certainly suitable. You've got control in most cases, although, it's quite, when we talk about private markets, it's a very heterogeneous asset class. It's quite difficult to generalize. And, as Desiree just kind of brought up venture capital there, that's a completely different ball game when it comes to engagement and ESG and responsible investment. But generally speaking, yes, you've got board members from the GP on the company. You control the company. There are differing. There's a pretty wide spectrum of approaches, though, when it comes to actually engaging with those companies in portfolios. A lot of GPs will take a very sort of collaborative approach. Management are the people that really know and understand the companies, and they're the people that are given often quite a bit of free rein to manage those companies in the way that they're paid to do. Other private equity firms, I've heard a small US PE firm when they were questioned about sort of alignment of interests and the way that they see the world from a DEI perspective, for example. So the question was, look, if the GP has a completely different view around DEI to that of senior management, what do you do about it? And 90% of the time, it's more of an engagement approach. But this firm basically said, well, we remove them and we bring in management who agree with us. So, there's a really wide range of sort of approaches. The only other thing I'd add, when you're sort of thinking about a public equity portfolio as well, especially some of the sort of more passive funds, you might have 100, 200 companies within that portfolio. Some private equity firms might have 15 to 20 investments in a fund. So, much more kind of concentrated risk. If you find one of those companies in the Wall Street Journal, it can be much more immediately traced back to you as a private equity owner. And especially when you have control, then, that raises a lot of questions. And I'm sure we've all seen, some of the negative headlines around private equity ownership recently with Thames Water and others. But beyond the sort of negative headlines, I still think there are a lot of positives.
We mentioned the sort of time horizons involved, and I think, Ben, you mentioned them in the context of them being sort of long-ish. Are they, if we say they're sort of 3-5 years, is that really the right sort of time horizon to affect change?
Yeah, so the typical private equity fund, about 10 years fund life. By investment, 3 to 5 years, but sometimes you do take longer. If you want to own the company and help them to improve, you have up to 10 years. You can work on that. Even typically 3 to 5 years, the deal, from your investment to exit. So that's about, that gives you really the long runway needed to effect change, because change does not happen overnight, right? And the other thing, I just want to comment on what Peter just said about working with the portfolio companies. I was on the way here, I was reading a wonderful research report actually done by Ben Caldecott. I have not had the pleasure meeting with him yet. I was so looking forward to meeting with him, but I know he's out. Unfortunately, he's out sick. But the paper, he's a lead author on that paper to talk about what are the transition mechanisms between finance, what we do, providing capital, to the real economy. And one of in that paper, he and the co-authors highlighted the most effective financial instrument to effect change in terms of sustainability is bank loans and then private equity. The reasons that Peter mentioned, for private equity, a portfolio company is owned by private equity firms, probably have 8 to 10 investors, roughly. Bank loans, particularly for smaller companies, they cannot easily have access to the public market, capital market, raise money in the public market. They have maybe only 1 or 2 bank loan lenders or private credit lenders. And if this lender come into the table to say, here I see the direction going of your industry, it's good for the business, financially speaking, and good for the society, you need to decarbonize. They really listen, because if they don't listen, they have only 1 or 2 sources of finance, very concentrated capital provider. And that's what gave you the influence to work with the company. And also in private, you are away from the public scrutiny, in a way, the public noise, day-to-day noise. So the long investment horizon is very important at this stage of our decarbonization journey.
One thing that's often struck me is that, yes, there is, as that sort of shareholder, often majority, but certainly with a big influence board and on management. Why is it that private markets portfolios are kind of behind the curve in terms of reporting on GHG to investors? For investors, that seems to be, if you have a portfolio, the private markets bid is a blind spot. Is there a good reason for that, or is it just because they haven't had the scrutiny that you get in public markets?
Want me to have a quick go? It's not necessarily a quick go. I think that there's a lot of answers, but it's right. They're certainly behind in terms of disclosure. It depends. If you ask a sort of private markets fund of funds, they generally say anywhere between 10 or maybe 30 to 40% of their managers may disclose some kind of climate information. Generally, that's kind of scope 1 and 2 financed emissions. Probably, there's a lot of estimations going on in there as well. CDP, I mean, it's interesting as well. Coming back to some of these charts and why it's important, I think, in private markets that there is more disclosure. I mean, I'm sure you get different numbers depending on which source you look at, but some estimates put the amount of carbon emissions from publicly listed companies at around 40% of total emissions, which leaves 60% in the hands of privately owned companies. And of those privately owned companies, only 1% actually report through CDP. So there's very little information out there. There is a lot being done, though, to try to rectify that. The root cause of the problem, beyond the kind of scrutiny issue or regulation, I think, is that, generally speaking, we're talking about smaller companies, SMEs. Often they lack the sort of climate literacy of much larger companies, the sophistication, the know-how, the budget, the teams. So the GPs that are doing a really good job of trying to get information out of those companies, after investment, and the horizon kind of question is a good one, actually, because people do think it's quite a long time, but a GP has got a lot to do from the moment they invest. One of the first things they end up having to do is really convince the management of the companies why kind of climate disclosure is important in the first place and why it's a risk to their business, etc. So they have to going to put the business case across a lot of the time. And then it's trying to build out the ability to actually report those numbers. So it's a bit of a mix of things. It's because they're smaller, less sophisticated companies in the first place. But then, I mean, maybe we can come back to the scrutiny side of things and stuff, but it is partly that too.
But interestingly, also, if you look at, I mean, that's, I'm sure, most of the market, but there's still the rise of B corporations and, of course, mission-driven private companies that are set up, you know, with climate or social objectives. And so I've certainly securitized and I've done portfolios of micro companies, you know, in frontier markets that have all the numbers, right? And they're very focused. That's how, you know, they've been built. There is also that market within private markets.
I would just say, actually, I'd invite anyone to put their hand up and ask questions throughout. We'll leave some time at the end, but it's quite nice if you have something to say or ask about. One at the back. Right there.
To a company called Novata together that, can you hear it? So we collect data on carbon and stuff like that. Can't?
Bob, we cannot hear you.
That's unusual.
No, we can.
It's a first. I'm pretty proud of myself. So this isn't a carbon question. This is basically a question about the private equity business model. You know, and you know I wrote about this last year, some just from a sustainability perspective. So if I recall the numbers right, 7 trillion going to 14 or 15 pretty soon. You know, look at that graph up there. I think the 2 and 20 structure is still in place, you know, maybe modulate a little bit by co-investing. Do you think the structure of the private equity industry can kind of stay as it is? I mean, Ben in particular, do you see enough opportunities? Is there enough opportunities for this amount of capital? Is the fee structure going to hold? And what do you think the implications are of that for the things that you're talking about? Because the industry has become so huge. I just wonder how this asset class can continue to operate in the way it's done in the past.
Fundamental
So,
question.
Yeah. On the fee structure 220, is a legacy. It is changing. From my own experience, in my past working experience as an LP, there are times you can negotiate down to the point maybe half of that. So that's part of it. But you're touching upon a bigger question, basically alignment of interest between LP, GP, and portfolio company. Is the fee structure is perfect alignment of interest or not? If GPs makes money, you get a 20%. If you lose money, LP hold the bag, basically, right? So I think that structure has to change over time. But the industry does serve a good purpose, has served a good purpose. Just think about all the new technologies funded by venture capital firms, and then private equity firm took over from them, continue to grow the company. So generally speaking, this is my personal view. I think there is a place for private equity in the capital market. But there are many issues coming up now. As you know, a couple of years ago, in a way they call it double dipping the fee, right? You know, fund level charge a fee, portfolio company charge another set of fee. So that's because of the disclosure, again, to the power of a disclosure. Because of disclosure requirement, that practice pretty much is dead now. So I'm hopeful over time, private equity industry will evolve as well.
I wonder if we should move on then to... sorry. Another question over there.
Thanks so much. Don't want to prolong it. Simon Hallett, Cambridge Associates and Net Zero Investment Consultants Initiative. So I guess I wonder whether we shouldn't be, as you know, we represent LPs and asset owners, we shouldn't just be much more ambitious in what's expected. As some of the initiatives like ILPA or ICI have tried to push for, GPs are not passive owners of businesses. In many cases, most cases, they have board representation, more than 25% of equity. It shouldn't be down to persuading management that it should be an inevitability. I spoke to the a partner in a New York buyout fund recently I put the question to him, if any of your portfolio companies weren't producing adequate emissions data at the very least, what would you do? And he said, well, we'd fire the management. So I think in return for our 2 in 20, I think we should have, or do you not think we should have higher expectations of GPs in this regard?
Who would like to take that?
To me, the short answer is yes, we should. And you mentioned ICI, which we support, and ILPA and others. The asset owners, the AOA, have recently kind of put out a call to action for private markets, sort of laying out what the AOA would like to see. But I think it's still in the minority. I mean, I mentioned this at the outset. I think it's still in the minority of GPs that would take that view of, look, I'm just going to remove management. I think there's a lot of deference to the skill and the knowledge of managers. Many GPs are generalists. They're investing in all sorts of different industries in different geographies. They're probably not, in all cases, the most expert people to be kind of saying how a company should exactly be run. But around getting data out of those companies, yes, it's just a matter of prioritization quite often, I think. There's a lot of talk around the costs that are involved to get information out, to staff it on the GP side, etc. So yeah, look, I think I think broadly we've talked about a lot of the things that aren't happening, but there is a lot of stuff that is happening out there. We have, I don't know how many it is now, but there's quite a few members of NZAM, which are private equity firms now. It must be up around 20 now, just at a guess. One private equity firm has kind of gone a step further, rather than just saying, here are our targets and we're going to commit to those targets. They've recently gone a little step further in saying, and it should almost really go without saying, but they've committed to being on track to those targets. So I guess going back to the transition sort of plan discussion that came before it, they're saying, yes, and we will ensure that we're on track to kind of hit those targets also. So there is a lot of good stuff going on out there. It's just, I think it started from a much lower base than in public markets, but are quickly adapting, I think.
It feels like the mechanism's certainly there, but it's just been slow to be used. Ben?
So maybe I can add an anecdote. Portfolio companies and GPs, actually, they want disclosure once you show it's an economic case. So in our experience working with portfolio companies, as Peter mentioned, many of them, they want to decarbonize, they don't know how. They do not have the intellectual, they don't have the capacity. We are the industry we are in every day. We think about, we talk about, we research. That's not their day job, right? So they need help. So once you position yourself, not just as a provider of capital, but also know how to get there. They know they want to get there. They just don't know how. And then from GP's perspective, if the direction of travel is very clear, the requirement in terms of data disclosure in the public market is already there. Europe, US, China, the 3 largest emitters and the 3 largest economic blocks, all requiring in public market. In the public market, you have to disclose your exposure, your carbon footprint, and other metrics. And then when you invest in private equity portfolio companies, most of the time, or many times, your hope the exit is a public market IPO. So the public market, you want to IPO 3 or 5 years later, and the direction of travel, public market already require that, you better get your X together before, so that you can go to tap into the public market or the IPO market. So normally they require 3 years of disclosure, So as I mentioned, your investment period only 3 to 5 years. So almost from day one, you want to start having the disclosure, build up your track record in terms of disclosure. Then when you go to the IPO market, you will be welcomed globally in many of the exchange. So this is a commercial case. And I keep on talking about the missing F in the ESG debate. It has to be there's a financial case, commercial case. And then once you help people realize that portfolio company and GPs that's the same direction we are going. Then the job becomes much easier. You are not fighting against the management team at all.
Take one more question. Oh, there's a couple more there. The rail pen at the back.
Hi, this is Chandra Gopinathan from Railpen. Just one question on, we're just switching gears to the public side a little bit. There's been a lot of focus on, from responsible investors in particular, on stewardship, engagement, governance, board structure, climate governance, all of those sorts of things. And as we just touched on a little bit before here, private markets and private equity in general have, on a relative basis, lower transparency and lower governance in all these respects. Now, when you look at outcomes in terms of investment and particularly in climate-related decarbonization technologies, et cetera, it's been immense from the private equity side. Do you think there's an inverse relationship here, and can we get some views from the private side on why the public, or what the public side should be focusing on a lot more? Are we too governed on the public side, and is that helping the private side to sort of get to the activities directly that need support and investment?
Paraphrase the question.
Was that a question? Thinking about where private companies are allocating capital, or?
It's about whether the governance structure or the lack thereof, or the lack of transparency on the private side is actually helping the decarbonization investment, which is really not the case, or is it impeding it on the public side and helping on the private side? So just curious to get views from the panel on that one.
Okay, so yeah, whether there's something about the private governance structure which is less transparent, but is it in some way also beneficial in terms of how it's managing to, or private equity or private markets firms are managing to invest in climate solutions? Yeah.
I think the governance structure, as we've kind of been over, is actually pretty good to do this. But the transparency is, to me, a slightly separate issue. And there is also a lot of work going on around that, right? So, ICI, for example, and sorry, I'm sort of saying it's shouting these acronyms out like everybody understands what it is. ICI stands for Initiative Climat International. So it's now 200 plus private equity firms that work together to try to figure out various sort of climate-related issues and build frameworks, et cetera. Now, one of the things they've been working on recently is a decarbonisation pathway, and it's to try to do exactly that, to bring a bit of transparency around what the industry is doing in terms of helping portfolio companies decarbonise, because I think they generally feel that they're, the good work that they do isn't, that the story isn't necessarily getting told very well, and that is partly because of that lack of transparency. So, when that's launched, and hopefully we'll get sort of pretty good uptake, it'll be a kind of a common language for private equity firms to communicate out to asset owners, to LPs, exactly what they're doing in terms of decarbonisation. So it takes I think it's sort of broadly aligned around the GFANZ buckets of, everything from cannot align to net zero to aligns to net zero and everything in between. And it asks the firms to essentially archetype all of their portfolio companies into one of those buckets. So then year on year, as you do it each year, you can see as an asset owner, how many or how much of the AUM of those companies is actually being shifted from, let's say, not yet aligning to now measuring to setting targets, et cetera, et cetera. So there are some efforts underway to increase the transparency of what they're doing, because the industry generally kind of sees itself as starting to do a pretty good job here. There might be that lack of data, lack of transparency, but they think, what they are genuinely doing, the work they're doing with companies is, a really important part of the energy transition. One of the big mantras at the moment from a lot of the firms is to go where the emissions are, because they know that they have the tools and the ability to actually help those companies decarbonise. So, going back to the whole argument around divestment, or engagement, I would argue that private equity is extremely adept, if it chooses to be, to make that happen.
Another point to make, of course, is that a lot of private equities, LPs, are also invested in the public markets. So, it's also a case that, asset owners, I'm not throwing stones, but obviously, need to, and it is happening, need to be more demanding, from their GPs, whether that's like a venture capital GP or it's private equity. But interestingly, right, you often see commonality of the GPs, of LPs, public or private. So the bottom line, the LPs need to be aligned with their mission across all their asset classes in their portfolio, not just focused on the public side.
That's been, I think, probably harder in private markets where there's a smaller number of top performing managers that you feel like you need to be invested with who can previously have had queues out round the block to give them money. So you make demands, they say, no, you can either subscribe or deal with it. But different environment now.
Yeah.
Yes, yeah. I think there was, okay, there's a couple more questions coming.
I have the microphone, so I'll go first. Hi, Billy Street from Barclays. I have maybe a concrete question to ask you guys about the gap, right? So we have on the one hand, kind of a wall of money that is being raised and that is supposedly kind of mobilized to go and invest into that space. On the other hand, we have big needs to finance the transition, but what's happening in practice is much smaller than either side, right? So I'm interested about your view in terms of concretely what kind of deals are getting funded and what kind of deals are not getting funded and why. Ben, I think you mentioned in some cases profitability issues, so probably economic issues. There may be as well non-economic issues. I'd be interested to have maybe your concrete experience of what gets funded and why, and what doesn't get funded and why, and how do we bridge the gap?
So if I understood the question, so basically in private equity, as we speak now, what kind of technology are being funded and what technology are not being funded by private equity industry?
We're actually going to go into that in a little bit in a moment, actually, in terms of the types of strategies in the sort of in terms of climate solutions, money being raised specifically for that. There was one other question. We'll get back to that.
Yeah, thank you. Karen Wilson, Associate Fellow here at Said Business School. A growing number of private equity firms and now venture capital firms are hiring people to lead sustainability efforts. And private equity already started that, I don't know, a number of years ago, but venture capital is really stepping up. What are your thoughts about the roles that those people are playing within the firm? And maybe more importantly, not only within the GP, but also how they're working with the portfolio companies. But more importantly, in my view, when will this be really integrated more strategically, where you don't just have a single person playing this kind of role? Thank you.
Would anyone like to start on that? I can say what we've seen.
I'm currently not at a GP, but as an observer, I think we're definitely improving. I think we've moved from that model, which you're talking about, having the sustainability officer, and I know one very big private equity fund that had hired a first-time global sustainability officer in like 2021, and that person reported to head of communications. That doesn't work. And so to your point, it's a knowledge set, it's, that needs to be embedded throughout. And I think from what I see, GPs are, cottoned on, and so they understand there's the enterprise and there's also, of course, their portfolios, and are embedding ESG qualifications into their private debt team, into their venture team, into the equity team, into, infrastructure. I do think that's happening, but it was definitely, it's still a work in progress. But I think the number of enforcement cases that have been out there and the scrutiny from LPs and demanding more stewardship, even on the debt side, that it's definitely improving. But I'll hand it over to other folks.
Yeah, so what I would like to add is that I want to initially, so you're right, the observation that GPs, are hiring the chief sustainability officer, building up the team. I want to initially is really in response. You think about some of the largest GPs that they are also public company, they're listed, right? So in a way, they are serving two masters, their LPs and their shareholders. So I want to initially, this is really in response to demand from LPs and then shareholders and their own employee. As you know, nowadays, when employee pick on the company they work for, particularly the younger generation, in addition to compensation, they also care about what the company stands for on many issues, particularly issues on climate change and social equality. So that I want to say initially really responding to this kind of LPs, shareholders, employees, but now really evolved to that now they see it again as a commercial case. There's a value creation through doing decarbonization or some other more proven ESG metrics that will help them deliver additional returns. So which is good. I think initially when LP shareholders are demanding this information, but then now we reach the point voluntarily GP sees value creation. They want voluntarily do it. So I see the evolution of this.
And the Inflation Reduction Act has done so much to accelerate that. It's not just the actual $400 billion that's been unleashed as grants, subsidies, and loans, but it's also validation of business model, right? So, I mean, the effect, take this with a grain of salt, but according to PitchBook, if you look at the venture space right now in climate tech for 2023, so this is this is through May 31st this year, North America on climate tech has jumped from 43% to 58%, and Europe has gone from 29% to 22%, and most folks attribute that to the effect of the IRA.
Yeah. So also maybe another anecdote, when I was in the seat of LP, I remember maybe 7-8 years ago, I started seeing the GPs in their deal underwriting memo, they start talking about data. Data is a new oil, right? When they underwrite a company, they will ask, does this investment generate data? Can we harness the data? Can we capitalize on the data? And now you see in addition to data, there's also in their underwriting memo is a whole section dedicated to sustainability. What does a company look like in 5 years? What is the society's expectation, the capital market expectation of a company like this in 5 years? So it's really becoming a business case now.
Just on the sustainability function question or hiring, we've seen all sorts of different, covering it as a journalist, as Desiree, as you said at the beginning, there was a lot of crossover with the comms and PR team, which is a bit depressing. And then there's also, some people would have had them reporting to the General Counsel as more of a sort of regulatory exercise. But now we're seeing sort of multiple people in a team, as well as bringing in kind of sort of teams of, I don't know whether you'd call them ambassadors or just kind of working groups, because it has to be the deal teams that are kind of taking these things into consideration. So kind of having a core team and then having a wider group of people from across the business too.
Well, I think someone said this earlier, that today with, younger people, I could say that as a Gen Xer, that they have a natural combination of skills. Right before, that's like some of all these greenwashing cases came because you had sustainability experts and then you had deal teams. And that's where the gap comes between say and do, right? One team is very aspirational, well-intentioned, and the other team is just focused on financial and ignores it or flips them off, right? And that's the real world. And I think today you've got a younger, generation of people coming into finance that naturally have both. They're financially and regulatory very astute and very passionate about sustainability, and that's combined, and that solves a lot of problems.
It's one of my favorite topics. Ben, do you want to start us off on that?
Sure. It may take me about 5 minutes. So I want to say, maybe for the lack of a better word, we had so much fun with designing the impact-linked carry. There's no industry standard. It's evolving very fast. It's well-intentioned, but it's quite a lot of complexity. So we see the pros and cons, and but even though with this uncertainty and complexity, we support the idea impact-linked carry. So there are the pros is that is really create alignment of interest, right? You do what you say. So part of the carry link to the 220. Bob was asking the fee structure model a moment ago. The 220. So part of the 20% is linked to an impact KPI. So the alignment interest there. They also is we feel like create more accountability now when we do the underwriting, because just very consciously knowing the impact linked carry, you pay extra attention to in underwriting the impact in addition to financial underwriting, you pay a lot of attention to impact underwriting as well. And then the other thing, when we debated, we didn't think of it, and later on became clear to us, because we have impact linked carry, we have been able to attract more talent, like-minded talent. They want to work for us because, again, we do what we say. So these are the pluses. And there, we had so much fun, but of course there is, the minuses as well, complexity, right? It's harder. Many of them, even carbon disclosure is not universally defined. So it's harder to quantify. And if you're harder to quantify, created risk can be gained, right? So how to be really authentic. And then the other thing, once you have an impact-linked carry, sometimes LP asks you the question, what's the trade-off between financial return and impact return? So you venture into that territory, then you have to really explain that, at least there's no trade-off. Again, again, my colleague and friend, dear friend Ann Simpson's here, she and I have been writing and talking about this topic that it has to be a commercial case. It cannot be a trade-off. If the trade-off, you cannot unlock the massive potential of the private capital to come to the table. So we got into, so one of the downside is that we had to explain to LP, this is not about a trade-off, gave up financial return for impact, for social environmental impact. The underwriting thesis, the financial underwriting thesis of the investment is a dovetail on the movement of decarbonization. And then again, some terms, again, the other paper Ann and I are working on now, we call greenium, the premium from investing in green. So about greenium, we highlighted a little bit in the article we just submitted for Journal Investment Management, but we're going to expand on the 6 sources of a potential return that investor can expect. So that's a long story to your question. The impact linked carry, there are pluses and minuses. The key minus is the complexity, but that shouldn't stop us from doing the right thing. So we do have impact linked carry design, and we're for it.
And I would just add that I would say for investors, right, you just need to look at fiduciary responsibilities here. And for a lot of GPs today, right, it's just regular way ESG investing where ESG is integrated into the investment process. And if that's the case, then, financial outcomes, it's what the fund is optimizing for. And likewise, there's a niche market called impact investing, where of course you can find impact opportunities or impact, sole GPs where you've got, environmental or social goals outweigh financials. They're still financial, returns, but the devil is in that detail. A lot of times, just regular way, a lot of the sustainability linkage, also for executive compensation, is aspirational and it's very ambiguous. I've seen a real-world example where my CEO knew he couldn't achieve the ESG KPIs, so he changed it the next year. He watered it down, and that's reality, and investors didn't catch it. Greenpeace did.
We have a... Oh, okay, sorry. Is it a comment or a question from Anne? Okay. We have,
I've been waiting a little while, but I can wait further if there's something that's directly germane. So I'm Jess Gasper. I work with FCLT Global. We're an organization that helps capital markets be longer term. And we do that through extending horizons for asset owners, asset managers, and corporates by broadening their business objectives and by increasing saver participation. We just completed a 6-month study on gray to green decarbonization, taking carbon-intensive companies and making them much less carbon-intensive with asset owners, asset managers, and corporates in the private markets. I can assure you, these guys are thrilled by this prospect. They see tremendous opportunity. There's immense eagerness to go after this problem, and there is a huge amount of flexibility in how they're ready to approach it. But there are real problems, because as they think through the problem, asset owners need to have very clear mandates and objectives. It's not the case that all asset owners are very clear there yet. Asset managers, including the private equity managers, they need to have a clear strategy and identify their clear competencies. Both groups need skill upgrading, and that comes back to the hiring question. If you look at some of the PE firms, they're hiring industrial experts to do decarbonization, folks who've already been at Amazon, folks who've already been at some of the leading organizations in this space. So they're after this, quickly, intensely. They see the opportunity, they're excited about it. And one firm I would just throw out there, which I think really sticks out, is CPP Investments, because they have direct ownership. They've decarbonized their work. They have a strategy to decarbonize their main mall here in Manchester in the UK. They've decarbonized pipelines. I know that might sound a bit funny, but you can easily think of, not having the material in the pipeline itself, but everything around it. They've decarbonized infrastructure projects. They've done at least a dozen of these things. And they say the rate of learning by doing these is amazing. You do one project here and you build the speed of your strategy, you build the speed of your implementation. It's just getting yourself involved and moving forward. So the big question is, what's the impediments? So I mentioned 2 of them. Another impediment is the carry. Like, how do you set that up? How do you set the contract up? What's the right way to make it work? You can imagine the private equity firm would love 2 and 20 and 20, right? You get 20 for your profit objective, you get 20 for your decarbonization. It's the new 2 and 40. But of course, the asset owner doesn't like that. They'd like to do 2 and 10 and 10. There's a lot of room in there. And so some of the things that people are doing are saying you don't get your capital market carry unless you hit your sustainability objective. So it's a multiplier. There's a lot of creativity going on here. So what I think I haven't heard as strongly here is like the enthusiasm, the excitement, the desire, the knowledge that this is an opportunity out there. They're not perfect, right? Nobody, I would say, is really there yet. But they've made a ton of progress, and there's definitely eagerness to move forward here. So I just want to keep that in mind.
thank you. Okay, so we've got a question at the back. We're going to have a quick comment from Anne, and then we're going to talk blended finance. But Pete.
Just to add one thing to that, I think a lot of the PE firms have really realised. I mean, the carry, linking carry, then the question around that. I think it's a very complex thing to do, and as Ben said, there's potential for unintended consequences, and it's just a complex thing to do. I've had the fortune or misfortune, I'm not sure which, to design an actual kind of carry allocation system at a GP where I used to work purely based on financial performance and returns for the deal teams. And it's complicated enough when you have all the drawbacks around IRR and all sorts of things, right? It's tough. And then layer the sustainability thing on top, I think it gets even tougher. But it's important to kind of find these incentives and the alignment of interest. And it's not just carry in private markets that's being linked to ESG or decarbonisation or whatever kind of metric you want to look at. There are SLLs, sustainability-linked loans going in for, with private credit. There are even a subscription. So private equity is mostly, a lot of the times, it's blind pool investing. So the GPs have credit facilities called subscription line financing, which kind of helps smooth the payments in from asset owners or make it easier. Many of those are getting linked to certain GP level sustainability KPIs. So there's a lot of that alignment of incentive going on. But I think one of the main things that's really driving the decarbonisation is exactly going back to your point, is GPs have realised that this is a value creation tool. And ever since some of the big consultants kind of pointed that out and highlighted it, everyone is quite quickly adapting to that and realizing. And it's not just what we need, I think, is more sort of industry asset class level hard data around that value creation. A lot of people are operating a little bit on gut feel and sort of common sense, i.e., if we decarbonize a company into, in 3-4 years' time, 5 years' time, we're looking to exit. The exit will be easier because a lot of the hard work has already been done, and financial kind of owners, other PE firms won't need to do that. The company is more resilient. It's more competitive versus other peer companies. So the exit is easier, probably, hopefully at a higher multiple. But just trying to get some real hard kind of numbers around that is quite important. There is some kind of work, Bain and EcoVadis, if you want to look that up at some point afterwards, recently released some sort of early data around private companies and how decarbonisation or DEI efforts actually create financial value. But we're still operating a little bit on kind of common sense, gut feel that this is the right thing to do for a value
One thing we
creation
should
perspective.
do is we should transition into the global south. So we're talking a lot about developed markets right now, and we know there's an urgent need, right? Because emissions are going up, right? And it would be, I think this maybe would be the right time to transition to blended finance and how we can, make real positive impact, and that's certainly in emerging and frontier markets.
Sorry, just before we do, Anne, you were going to say something?
Yeah, no, Danielle's comment is the perfect link, because we've got concessional finance at work already. We've got $500 billion of subsidies to fossil fuel, so we need to sort that out. Now we've got a shift in the thinking about blended finance through the incentives in the Inflation Reduction Act. So as Danielle says, this question about financing the transition, particularly in countries that are not the responsible for the emissions, but are now most vulnerable to the impact. This is a question at the heart of responsibility for what's needed. So what Ben and I have been working through is actually to get the blended finance, the concessional finance piece worked into our strategy, because as Rachel Kite, colleague from the World Bank, we've got a role for concessional finance, which goes far beyond philanthropy and family offices. It's the big money out of the development banks. It's also what's baked into the subsidies that we need to unravel and the subsidies that are being put in. So that's one thing. Government, the taxpayer, is already footing the bill in all kinds of ways we need to be aware of and use effectively. The second thing is, if we're talking about sustainability, who decides what that means? I mean, how does it show up? What standards? So what we are using as our guide, of course, is the Sustainable Development Goals, some of which are remember, they're designed for government, but the investable pieces, they might be by sector. So food, obviously vitally important, energy, of course, that's obvious. You get the sector pieces and the metrics, but then there are cross-cutting themes like decent work, gender equality. So the model we're building takes the sector piece and it takes the thematic piece, and then it says, hey, how does that show up in an investment?
Sorry, I'm sorry to cut you off. I do think we're straying into Alex's area, and it would be great to get your views on.
I apologize deeply.
I don't want to run out of time, that's all. And we haven't got into the concessionary capital and how that can be brought into play with private markets.
It's all good. I had like zero value to add to the question so far, so perfectly happy to be quiet. What to say? Well, I mean, so I do nearly all of my work is in the global south, and the reality of this decarbonization narrative. If we're thinking about where capital investments need to be made in infrastructure, it's predominantly in the global south, right? And we know that the private capital markets were going to have to play a big role there, because public balance sheets, certainly in the global south, aren't that robust, and have become less robust since the pandemic, and even less robust since geopolitical tensions over the last 18 months. So then the question is, well, how do you mobilize private capital in opportunities where either the return is perceived to be too low or the risk is perceived to be too high? And here is the sort of segue into what the expectations are of blended finance. And this kind of came up as a big thing in the keynote, I think, yesterday, and there was a good question about that. I just want to put a couple of realities out there about blended finance from the world that I operate in. So the chart behind us is showing, I think, private capital flows over the last, how long? About 15 years, is it? Yeah, something like that. So I'm just going to quote some numbers from an outfit called Convergence. It's convergence.finance. They're a not-for-profit that they record information on blended finance. So according to Convergence, over the last decade, 2014 to 2023, the total amount of capital committed to blended finance transactions is $182 billion. $182 billion over the last decade against $1 trillion of private capital issuance in the last year alone. Okay, so let's just think about what that means in terms of what our expectations are of blended finance. Of that amount, about 50% is in what we call concessional finance, or cheap money. About another 25% in technical assistance, which is money, right? And then about another 15% in concessional credit enhancements, right? So guarantees and so on and so forth. A quarter of those transactions are in energy, and a quarter of them are in about financial services. But the issue that I want to bring up about this, not just the quantum being what it is, but it's just to understand the motivations that operate amongst MDBs, amongst multilateral developers, lenders, and so forth. If you meet, as I've spent a lot of my life doing, too much of my life sometimes, but if you spend your time meeting loan officers of a development bank, and you meet a loan officer of a commercial bank, very difficult to spot the difference, right? They all join the same golf clubs, they send their kids to the same schools, they eat in the same restaurants, they actually earn about the same amount of money. The main point is their incentive is almost identical. The incentive of a commercial loan officer is don't lose money and make the bank money. The incentive for a MDB loan officer in that role is don't lose money, make the bank money. So what ends up happening is that concessional finance chases those opportunities which are the least risky, right? It's common sense. If you're incentivized not to lose money and to make money, why would you do any different, even if somebody else in your bank is saying, we're here for the blended finance? And so what ends up happening is if you have a viable project, right? You have a viable project, you've got cash flows, you can, whatever. And somebody's saying, okay, I'll lend you money against that at 6%. And somebody's saying, I'll lend you money that at 3%. What are you going to do? You're going to take the cheap money every single time, right? Of course you are. That's a rational thing to do. So what ends up happening is, for the most viable projects, concessional finance crowds out private finance and destroys that market. So projects that shouldn't be funded by what is a subsidy get funded. And then there's less money available for the other stuff. And the thing is, as long as that happens, you're never going to really scale up the blended finance opportunity. And the other thing to bear in mind, right? If over half of blended finance transactions are based in concessional finance, what is concessional finance? Taxpayer money is what it is, right? Taxpayer money is what's concessional finance. Somebody is taking a subsidy and giving it there. And the world is changing, right? I mean, in this country, in the UK, you'd have seen this week, Tata, through Jaguar Land Rover, has just been decided to put a battery factory here in the UK rather than in Spain. And the way that was done, as far as we can tell, is by a shed load of government subsidy going into putting that infrastructure here for the decarbonization. So if you're a rich country government and you're working out, I want to put a bunch of money into concessional finance and blended finance, where the outcomes are indeterminate and you might crowd out and do all of these things, or I want to get jobs and all of that stuff going on here by putting that subsidy in here, what are you going to do? You're going to be doing more and more of that. So I think this whole framing of the blended finance narrative right now, from where people like me sit, it's not going to work. Right? It's not going to scale. And we need to have an honest discussion about who's being incentivized to make this capital available. Should there be sectors, like is energy and financial services really where blended finance should be going into, where the models are probably clearer than anywhere else? I don't know. But I think that the whole opportunity, the unlock opportunity of private markets and private equity capital into the global south, which is where at the margin probably the most heavy lifting needs to be done, we need a fundamental rethink about that process, I think.
I absolutely agree. I have done so many of these blended finance transactions. And actually, I was representing pension funds, insurance companies, family offices, bringing them into impact strategies, right, using FMO, or in the United States, the DFC, OPIC, right, using concessionary finance to mobilize private capital coming in. And so often, I was accused by the development agencies of crowding them out. Their purpose is again using taxpayer money to be leveraged to bring in private capital. And right now, the incentive is an issue, but there is such a big cultural divide as well. I mean, there were deals that I've done where they were just nasty fights between these two worlds, largely because lack of communication. And so you've got some folks working in development agencies, politically motivated, they get paid on volume, they don't get paid on impact, and some of them just don't understand. They don't have a good financial background, even a regulatory background, right? And then you've got, of course, the capital markets, where you've got a flow monster right now, and you've got very high base salaries, and people have become a lot more cookie cutter, and the incentives aren't there either to do innovative deals. They'll be more niche. And absolutely, we need to confront this because, right, while we're, probably going to decarbonize because of our governments and cushy status of life, we need to confront the real problems here, and blended finance is one of the tools, but we have to address this cultural divide and incentive dislocation.
It seems like there's a pretty clear problem, but is there any sort of hint of a solution? Is it a different risk profile for the development banks, or?
Well, I think there are. It'd be interesting to hear what the room has to say. I think you need to walk the talk. If you're an MDB, you need to make sure the incentive of the loan officer is lined up to what the bank is then saying at the COPs and all that. There are specific things to be done, and it can be done. This is not like a hopeless situation because capital wants to get to work. Yeah. But the status quo is not going to do it.
There needs education. I remember being on the phone with a couple of government agencies, and we're talking about an impact securitization, and these government officials are like, we can't do that. That's what blew up the world. And you're going no, it was the underlying actual loans. It's not the structure. So it's education is one of the keys.
So someone has had the microphone for a very long time at the back, waiting patiently.
So, hi, it's Navin Rawnia here, Sustainability Partner at Tata. So very timely comments. Very, very timely comments. So I think one thing that we need to recognize when we look at Tata, it's a global South company. It's headquartered in India. Capital flow is now reversing. We also need to be very clear, where did emissions happen? Higher standard of living, as was said in the panel, is in the West. But destroying an economy or slowing an economy down because their emissions are high, because they want the same standard of living in the East wants the same standard of living in the West, that needs to be dealt with very sensitively. We talk about this $100 billion of capital that needs to flow from West to East as well, and in different forms, as Alex mentioned as well. But we have two elephants in the room, and I think the question of the panel is, how do we channel private capital into emerging markets, given that public capital, all the data points, frameworks, etc., tend to come out in the media, and then there's a lot of criticism. The two elephants, well, UN SDGs out till 2030, right? We know very clearly that we're not going to hit those goals in 2030. Secondly, net zero. Turkey 2053, Middle East 2060, China 2060, India 2070 as well. We cannot go and penalize half the global south, not for the large corporates, but for the small, medium enterprise businesses, the mom and dad businesses, mom and pop businesses that are out there that actually fuel the economy of emerging markets as well. So what's the view on the panel from private markets funding a just transition, may I say? Thank you.
Thank you for the question. So yeah, how to channel private capital, private fund money into a just transition. Would anyone want to take that?
Well, I mean, one of the aspects is having development agencies work with the private capital here, right, to help sometimes de-risk a portfolio, provide further data to technical assistance. So that is part of, right, of a solution to get both sides to work better together. And then, otherwise it's further education about, investment opportunities in emerging markets, and very much highlighting this is very much, you're absolutely spot on, we caused this problem, this is about environmental justice. However, guilt alone isn't going to drive the flows that we need, right? So it needs to be also financially viable, and development agencies need to step up more, do a better job.
Is there a Franklin Templeton view on that?
I will just add one thing on the just transition. So in a way, it's also among different countries. So think of you are more developed, more resourceful country, but surrounded by less developed, less resourceful country. There are already climate migration. Later, maybe become climate refugee, and that may lead something social unrest, or may even lead to war between neighboring countries. So in terms of just transition, for richer countries, more resourceful countries, they have to pay attention to the just transition across countries. Otherwise, these richer and more resourceful countries will be flooded with a climate refugee, and that will destroy the very foundation of their country being rich and more developed. So the just transition, many layers, not just within one country, different societies, different ethnic groups, but also on the global stage. And we know, their foundation organizations like Ford Foundation, they're very much focused on the social impact of climate change, the just transition of climate change. And MDBs can play a key role, in terms of ensuring a just transition, particularly across countries.
Just want to take them all and then we'll consolidate.
Sorry, just coming back to the point on blended finance and how development banks need to do more, et cetera. I think one of the things that we haven't touched on is risk culture across Elme. As we know, culture eats strategy for breakfast. So what can we do to change risk appetite? I mean, Alex quoted some good numbers around 182 billion for blended finance versus $1 trillion. And the expectation was, 4:1, 5:1, 10:1 leveraging of private capital, which is going to happen and be mobilized. Now, that's not going to happen if MDBs actually need a senior secured preferred creditor status when they give a first loss guarantee. So anybody who's worked with the development bank will be aware that the requirements from a risk appetite and a risk construct perspective is almost pari passu with what private capital gets, most of the times. Now, that needs to change overall. So what I'm curious to hear is, what are we thinking in terms of, for that 180 billion to actually go into the trillions, that needs to change in terms of culture. It's not just about education, it's also about risk appetite as a whole. So how do we incentivize the MDBs? How do we get that change to happen for this to be mobilized better?
Well, okay. I'll just give I'm quite keen to hear what else people have said. I mean, I think your question is absolutely on point, right? But so this is where things like the loss and damage funds and all, there's these new commitments that are being made from public money, pools of public money to become available. This is our hope, right? Expecting the existing amount of money available to be repurposed and releveraged. I can't see it. I can't see the numbers. But if there is a genuine view that there is going to be these larger pools of money being created through loss and damage, etc. What we need is a new approach to thinking about how does that get redeployed in the way to create this leverage. I mean, it's not going to fix it, but it's going to be part of it, I think. Yeah, there's lots of.
So just a sort of enhancement or follow on. I'm Vikram Wage with the Climate Policy Initiative. Full disclosure, I was with the International Finance Corporation for 25 years. So while I would disagree with some of the characterization, and we're not going to get into the incentives for development bankers, but more importantly, I think it's a fallacy to think that combining private capital with MDB capital becomes blended finance. To the point the gentleman made there, I think development banks, especially those private sector oriented like IFC and perhaps EBRD and others, think of themselves as private financiers in many ways and want the same level of return for their risk. Now, what their cost of capital, the models look like may vary and the rates may be a little different from market, but they're not concessional by any means. So trying to change that structure is probably much more difficult than perhaps looking at an alternative way to deploying blended finance that is extremely limited and therefore precious. And a lot of the capital concessional money provided by donors, which the MDBs use with and without the private sector, is what I call retail oriented. It's literally project by project. And to your point, Alex, I think we need to look at a different shift in paradigm. We need to make it a little more wholesale. If you're going to create all the barriers to access, then we might as well at least make sure that the platforms that we create are more widely available to the private sector. Whether they're administered by an MDB or not, we won't get into that debate. And the other thing is concessional capital needs to become much more flexible. It has to be able to address a spectrum of risks because it runs this whole, just providing some subsidy to the interest rate is not going to get us to where we really need to. So I think that's sort of a paradigm shift and a new approach to partnering with the private sector using this concessional money is probably necessary and needed.
But don't you think that naturally happens if the development banks constantly move downstream, that the private markets, you create ecosystems? I mean, let's not forget Silicon Valley was subsidized. It was Department of Defense. That wasn't as natural that, Palo Alto appeared. It was government funded, and then private markets took over. So couldn't you have a model where development banks are constantly moving downstream, perhaps?
Perhaps that, or perhaps what is being, the moniker used is originate to distribute, right? Most multilateral, most development agencies originate to hold for the long term. But if they have the machine to originate to de-risk, then why not originate and essentially underwrite a much larger chunk, most of which then you distribute after a certain amount of de-risking has happened to the private sector. That actually might even further reduce the need for more concessional capital if that machine is deployed better. So, thank you.
I mean, I completely agree. I mean, that's kind of, people talk about the ready-to-run securitization that FDB is doing and so on. It's kind of along those lines. Yeah. So, yeah.
But that also takes education.
Yeah, exactly.
Hi, Riccardo Saluzzi from Lewis. I just want to give you a personal experience. I used to work at EBRD, and I was the lawyer on the Chernobyl G7 project and the Russian Business Fund and other projects. Now, in terms of how you literally need to have, state or financing or state backing, and the way those projects were structured, that you have a guarantee in terms of first loss from the states. So this is something which at the level of IFC, EBRD, all the development bank has been done in many years. So, I mean, this is a possible solution. The other one is the Gavi initiative, which eventually, there is a discussion on whether, you can do something similar to what the Gavi initiative did. And the other one is what the gentleman said about distribution. I think the development bank are very bad at distributing. Even when we had the AB loans at the very beginning with the IFC, BRD, it wasn't really a tool which was used to the fullest extent, but actually was a very good initiative to make sure that the private sector could come along. And there is the mentality clearly of holding the debt position, because if there is a distress, you think that you're going to be important. And also, I think the other aspect is that due to the issue that we're going to have with disruption of markets due to climate change, having development banks coming in terms of holding the political risk becomes even more important. And it's something where I think there is more, should be more availability of funding in that respect.
Thank you very much. Sorry, we've rather lost track of time, but thank you all for the contributions, and thank you to our panel as well. It was fantastic.
Are we done?